Hey guys, welcome back to the channel. So today we're going to talk about gold, right? Is it time to add some gold to your portfolio? Yes, maybe, no, perhaps, who knows, right? But we're going to dive into it. Because if you've never invested in gold before, you really need to do some research before you do, right? Because with the financial markets, just they keep setting new record highs, and generally gold has been calm for the last several years. It might be a really good time to buy some gold. Gold might be the most controversial investment, of modern times. And it's withstood the test of time. I mean, really, right? It's been acting as money since ancient times, right? And no one really knows how to categorize it as an investment. It might be best to say gold is less of an investment and more of a store of value, right? It doesn't pay interest or dividends, and it would hardly qualify as an all-weather investment. On the other hand, after trading at a fixed price of $35 per ounce through 1971, it's now valued at over $1,300. That means the value of the metal has increased by a factor of 37 in about 40 years. So, even if gold isn't an investment in the strict sense, that kind of price performance, come on, we can't ignore that, right? I mean, that's crazy. And for that reason, you may want to consider adding some gold to your investment portfolio. Okay, well, when would you buy gold? Why would you buy gold? Well, whether gold qualifies as a legitimate investment or not, it's clear that it's more than to keep up with inflation, right? Let's take an example. In 1970, the median price of a house in the U.S. was about $23,600. At $35 an ounce, it took 674 ounces of gold to buy a median priced home. Okay, well, by the end of 2017, the median price of a house had risen to almost $249,000. At roughly $1,300 an ounce, it now takes only 191 ounces of gold to buy the median price hold. Right? So the value of gold has increased 3.5 times faster than the cost of a median priced house since 1970. Now, that's not as dramatic as some other investments, but it's still really good, right? And honestly, that's why you can't really ignore gold, right? Despite some claims of other people, right? And then some people say gold is mostly a crisis investment, right? Because while serving mostly as a store of value, gold has also proven to be a winning investment during uncertain times. Based on historic performance, it's clear that gold is more erratic than other investments. For example, it performed very well during the 1970s, rising from $35 an ounce in 1970 to a high of $850 in 1980. It dropped about 50% pretty shortly after that, and then kind of hung about for most of the 1980s and 90s, right? It's kind of It then went from a near-term low of 252 right before 2000 to an all-time high of over 1,900 per ounce in 2011, rising by a factor of nearly 8 in 11 years. It's come down about 1/3 from those heights and has been range-bound ever since. Well, one of the things that we've seen are, there's two time frames, right? The decade of the 70s and a 12-year span from 99 to 2011 in which gold went parabolic. In other decades, it was either flat or gradually declining. And that performance, I mean, it's not insignificant, right? The 1970s were characterized by a lack of confidence in both the U.S. dollar and the U.S. government, leading to consistent inflation. The period from 99 through 2011 experienced two major stock market crashes and two deep recessions, the dot-com bust and the financial meltdown. It's not a coincidence that gold had its best performances during those two specific time frames. It virtually went to sleep or declined in other decades, but it performed especially well during the two time frames when confidence in both the financial system and other investments was really low. This is why some gold advocates have referred to the metal as a counter-cyclical investment, right? It tends to perform best in times of crisis, and especially when confidence in the system overall is low. That makes it worth considering as an addition to your portfolio. Well, how has gold performed against other investments? Well, there's a website called engineeredportfolio.com. It's done a lot of research and analysis comparing the performance of different asset classes between 1972 and 2016. So we're going to go over some of those results, net of an average annual rate of inflation of about 4%, right? So REITs are about 9.2%, right? US stocks are about 7.7%, gold is 6.3%, commodities 4.8%, long-term treasuries 4.2%, US bonds 3.2%, right? Now, you know, these they put in a lot of research. So I mean, honestly, I would say that some of those numbers are really close to each other, right? But it really shouldn't be a surprise that REITs outperform the field, right? Given that real estate is typically levered, right? It's just real estate's always just leverage, right? Stocks have clearly outperformed gold over the long term, but it's also clear that gold was a winner in more difficult decades when conventional investments didn't perform well. Those performances have reinforced gold as a safe haven asset, particularly favored by international investors during times of crisis, right? Since we can never know when a prolonged time of underperformance by conventional investments will begin, it can make sense to hold at least a small portion in gold at all times. What we do know is that all financial markets run in cycles. The current bull market in the stocks that began in 2009 has seen the value of stocks roughly quadruple in just 9 years. While it may be tempting to assume this performance will continue forever, the history books don't really support that. A prolonged downturn in the financial markets, like stocks and bonds, it might ignite the price of gold. And anytime you plan to buy into an asset class, it's always best to do so when the price is stable. If you wait until a crisis causes gold to rise, you could miss out on the best buying opportunity. Okay, well, then now if you're convinced to buy gold, what's the best way to buy gold, right? Well, there's several ways to invest in gold, which you decide on, it should really be based on your preferences, right? Like, don't just have someone tell you what to do, right? You should really kind of decide, what you feel most comfortable with. But you could buy, like physical gold, right? Or gold coins, right? Can be purchased in denominations of 1 ounce, half an ounce, quarter ounce, and 1/10 ounce coins. There are various coins, the American Eagle, Canadian Maple Leaf, South African coin. They typically sell at markups of anywhere between 4% and 10% of their bullion content. Gold coins have the advantage that you can take physical possession of them. They're also completely portable. On the downside, storage can be an issue. There's always the threat of theft, as well as destruction by fire or earthquake. It's generally advised to have them insured against loss. They can be purchased at local coin dealers, large brokers, Goldline, JM Bullion, Ampex, or APMEX, I'm sorry. Gold bars are another physical gold you can do. They're for who wants to hold the actual metal, but want to take a position that's too large for individual coins. You can purchase them in sizes ranging from half a gram to 1 kilo, and they can be purchased at large dealers, right? The advantage of gold bars is they have lower price markups than coins. The disadvantage is that they aren't divisible the way coins are and must be purchased in large amounts. For this reason, they're not suitable for small investors. Of course, then we have gold ETFs. These are essentially index funds for gold, right? A gold ETF is invested primarily or exclusively the metal. It's an opportunity to invest in gold without taking any physical custody of the investment. The two largest gold ETFs are SPDR Gold Shares and iShares Gold Trust, right? They can be purchased through investment brokers, right? Just pick your, whoever you go with. And then there's non-bullion gold investments, right? Because you can also invest in paper assets of companies engaged in gold production. These are not like investing in the metal itself, but rather in the business side of production. They can often outperform the metal itself, and they can just as easily underperform it. Then, of course, there's gold stocks. These are stocks in gold mining companies, and not in the metal itself. Though they have an approximate tie with the gold price, They're also subject to all the risk and pressures of any business. That can include the risk of unproductive mines, labor strikes, political unrest in countries where production is taking place, and changes in foreign currency exchange rates. Gold stocks are extremely risky and are speculations at best. They tend to perform best when gold is in a prolonged bull market. They can represent a diversification within an overall gold position, but should not be mistaken for the metal itself. Then we have gold mutual funds. As you might expect, these are funds that hold the stock of several gold mining companies. They're somewhat less risky than individual gold stocks because they hold only the better performing companies. Some also take a limited position in the metal itself. But just like gold stocks, they perform best in prolonged bull markets in gold, but do poorly when gold is in decline. Well, what would I recommend then? I would say since gold only performs well in very specific markets, it's best to hold a small percentage of your portfolio in it. Generally, you don't invest more than 5 to 10% of your portfolio in precious metals. Investing in the metal is the best, right? You should plan to hold gold bullion coins or gold bars if you want to hold the metal itself. Alternatively, you can invest in a gold ETF, which you can hold in your portfolio just as you would any other security. Gold stocks and mutual funds are best avoided. Unless you're looking for diversification during a run-up in gold prices, these are special circumstance investments and are not meant to be held permanently. So then how would we summarize all this? Well, if you've never invested in gold before, do a lot of research. Look into it. But with the financial markets, constantly new record high, and gold being calm, it might be a really good time to get into it. But don't just get carried away and load a portfolio with gold and gold-related assets, right? So do your research, get in there and try to figure out what it is exactly, you want and how you want to do it, right? Hopefully you guys got some good information out of this. Maybe you learned a couple things. If you did, go ahead and like the video, subscribe to the channel for more, and I'll see you guys in the next video. Y'all be safe.